You found the perfect house, and the seller accepted your offer, and your loan process is underway until your appraisal comes in at a value less than you're paying for the home. If you've ever wondered what happens when a house doesn't appraise, as we say in the real estate industry, come as you are and let's learn how to rock a low appraisal value starting right now. Hey guys, welcome to Rockin' Real Estate. I'm Rob Spinosa with Guaranteed Rate. If you're a home buyer, a homeowner, or even a real estate professional looking for home finance tips, tricks, and the occasional cool guitar licks, I've got your backstage pass to a better understanding of the mortgage business. Before we begin, if you're presently dealing with an immediate and stressful appraisal issue yourself, and you don't have time to watch the rest of this video, give us a call directly at 415-367-5959. Okay, so let's first talk about what happens for most buyers when a seller accepts their offer to purchase a home. If the buyer is obtaining a mortgage, and that's most buyers, then usually an appraisal will be needed to support the value of the home for the lender's purposes. Oh, and the appraisal itself? It's a report prepared by a certified real estate appraiser, and it's a professional opinion of the home's value. Yes, the appraiser sees a copy of the purchase contract, but more importantly, the appraiser will seek out several comparable properties, or comps as they're called. These are homes in the area that have sold recently and that have similar characteristics to the home that you're buying. The appraiser will assess their sales price and make adjustments on the appraisal report to relate them to your property. And when the report is complete, it will provide an opinion of value on your home. Most times that opinion will align with the sale price, but it's possible that it may not. And when it's a value that comes in lower than the sales price, it may have an impact on your mortgage terms and loan approval. Let's take a look at why. The fundamental concept we must understand before solving for a low appraisal value is loan to value, or LTV. Using round numbers for our demonstrations to follow, if we have a sales price and an appraised value of $1 million and a loan amount of $800,000, we have an LTV of 80%. If we have a purchase price of $1 million and an appraised value of $1 million and we have a loan amount of $600,000, we have an LTV of 60%. So now what happens if we have a purchase price of $1 million and an appraised value of $950,000 and a loan amount of $800,000? Okay, in the residential lending industry, lenders will use the lesser of the purchase price or appraised value to determine the LTV. Let me state that again. We'll use the lesser of the two values, which in our example above was $950,000. So in this case, we have to figure out the LTV when $800,000 is the loan amount and $950,000 determines the value, not $1 million. In other words, we would now have an LTV of 84.21% and not 80%. Hold the thought on the $600,000 loan amount example for just a minute. We'll get to that soon. Now that we've got a low value we have to deal with, there are usually 4 paths forward. Number 1, the buyer bridges the gap by making a larger down payment. Let's use LTV again as our metric. If, for any number of reasons, the buyer can only borrow up to 80% of $950,000, then our maximum loan amount is $760,000. If the home is still being bought for $1 million, the buyer must now come in with a down payment of $240,000 instead of $200,000 had they been able to get an $800,000 loan. Number 2, the seller can agree to lower the price. If in our example above, the seller agreed to lower the price to the appraised value, the buyer would get a $760,000 loan and save $50,000 off the purchase price. Number 3, the buyer can use a mortgage program that allows for a higher LTV. Yes, this may trigger private mortgage insurance or PMI, or it may require a higher rate or a different loan program altogether, but there are certainly cases where this is worth pursuing. And back to our $600,000 example from earlier. If the buyer planned to get a $600,000 loan amount on a purchase price of $1 million and the appraised value came in at $950,000, here we'd have a loan to value of 63%. In short, the buyer would not be forced to make any changes to the loan size because a 63% LTV doesn't cross any loan guideline threshold and it doesn't by itself require any loan structure changes. Whereas crossing an 80% LTV or a 90% LTV, for example, would have much more immediate ramifications. This is a loan guideline thing, and it's somewhat technical, so get in touch or leave a comment below if you have any questions. And finally, option 4. If the house doesn't appraise, you can get out of the contract altogether in some cases. FHA loans, for example, will have an amendatory or an escape clause, which allows the buyer to get out of the contract if the home doesn't appraise at the price the buyer is paying for it. But before you cancel any contract, make sure you understand its terms by discussing it with your real estate agent. Buying a home is stressful enough, even without appraisal value issues. But if you find yourself dealing with an appraisal that comes in low, or if you have questions about any other aspect of the mortgage process that will get you the financing you need, don't hesitate to get in touch at any of the links below or by calling us directly at 415-367-5959. And if you found today's video helpful, please click on the like and subscribe buttons below, and we'll keep the hits coming.